Welcome back to the deep dive. It is Saturday, February 21st, 2026. And, if you've been glued to your terminal or just doom scrolling through the financial news over the last 24 hours, you probably know that the world feels fundamentally different this morning than it did on Thursday.
Yeah, it really does.
We're looking at a market that is trying to digest these massive structural shifts, and they're all colliding at the exact same moment.
That's exactly right. It's one of those rare weekends where you really can't just look at the ticker to understand what's happening. I mean, you have to look at the plumbing.
Right, the underlying mechanics.
Exactly. The fundamental architecture of how business is done, how software is sold, and honestly, how the global financial system is held together. It's all shifting under our feet right now.
Yeah, and we have a serious stack of headlines to get through today. We aren't just talking about the daily noise here, we are talking about the signals. So first up, the tech world is absolutely reeling.
Reeling is putting it mildly.
Seriously. A single product announcement from Anthropic yesterday has wiped billions, literally billions of dollars off the stock market valuations of traditional cybersecurity companies. And it might just be the first domino in what some analysts are calling the death of SaaS.
It's a really strong term, right? The death of SaaS. It sounds like pure hyperbole, but when we actually look at the data, the valuation compression, the revenue models, the argument is becoming really hard to ignore. We're seeing this massive shift from buying seats for humans to hiring agents that just do the work themselves.
Exactly. And, while Silicon Valley is freaking out about the future of software revenue, we have this quiet, terrifying crisis brewing over in Japan.
The life insurers.
Right. Life insurers there are sitting on record-breaking losses. We are talking about an $86 billion hole. This is a massive warning sign for the global bond market that, frankly, most people here are completely ignoring.
Yeah, and it's the lag effect of the end of that whole free money era. It is finally hitting the institutional balance sheets where it hurts the absolute most. You can hide paper losses for a while, but eventually the math wins.
The math always wins. And speaking of the end of free money, we are seeing it in the real economy, too. The whole COVID bubble in luxury goods watches, rare whiskey, it has finally popped.
It is officially a buyer's market there.
It really is. And finally, to cap it all off, we have a fascinating new proposal from DeepMind's Demis Hassabis on how to actually test for AGI. It's not a coding test, it's the Einstein test.
Which is incredibly relevant right now, because if we are going to rely on these AI agents to run our economy and essentially replace our software, we really need to know if they are actually intelligent or just, really good parrots.
Exactly. So our mission today is to cut through all this noise. We want to understand these structural changes. This isn't just a breakdown of whether you should buy or sell a specific stock today. It's about understanding the landscape of 2026.
Precisely. We need to connect the dots between a code scanner in San Francisco and a life insurance office in Tokyo, because they are way more connected than you might think.
Okay, let's unpack this. We have to start with the tectonic shift in AI and the market crash we saw yesterday. The catalyst was Anthropic releasing Claude Code Security. This just dropped yesterday, February 20th.
Right. And on the surface, if you just read the press release, it sounds like just another feature update. Like, hey, our AI can scan your code for bugs.
Which we've had for a long time.
Exactly. We've had code scanners for years. Developers use static analysis tools. They use linters. It sounds mundane. But the market reaction tells you this is entirely different.
So how so? I mean, what makes this different from the tools developers have been using for the last decade?
So traditional tools, what we call SaaS or static application security testing, they're basically glorified spell checkers. They look for known patterns. They have a massive database of bad things, like a specific way a developer might write a password into a file or a known insecure function. And if they see that exact pattern, they flag it. It's just a matching game. It's very rigid.
So it's like looking for a specific shape of a key, and if the key doesn't fit the shape, it yells at you.
That's a great way to put it. But what Anthropic announced is that Claude Code Security actually reads and reasons about the code like a human security researcher would. It doesn't just look at the raw syntax. It builds a mental model of the entire application.
Wow.
Yeah. It understands how component A talks to component B and exactly how data flows from the user input all the way down to the database.
So it's not just hitting Control F for the word password, it's actually understanding the logic of the program.
Precisely. It can find complex vulnerabilities that rule-based tools simply miss, because those vulnerabilities don't fit a predefined pattern. They are logical flaws. Maybe the code is written perfectly in terms of syntax, but the business logic allows a user to bypass a security check if they just do 3 specific things in a row. A pattern matcher misses that completely. Claude catches it.
And the results from their testing were pretty staggering. They used CloudOpus 4.6, the big model, and they unleashed it on production open source code bases.
And here is the real kicker it found: over 500 critical vulnerabilities.
500.
500. And some of those bugs had gone undetected for decades. These are major code bases that expert humans have been looking at for 20 years. Dedicated security researchers have combed through them, and the AI found things they missed, and it did it in minutes.
That is both incredibly impressive and honestly a little terrifying. I mean, Anthropic even called it a double-edged sword in their announcement. They openly admitted that the exact same AI that helps defenders fix these bugs can help attackers find them and exploit them much, much faster.
That is the arms race we are in now. Attackers will use AI to scan the world's code. If I'm a bad actor, I can just feed an open source library into Claude and say, hey, find me a zero-day exploit. And it will.
Right.
So Anthropic is positioning this as a defensive necessity. They're basically saying, the bad guys already have this capability, so we are giving it to the good guys to patch the holes first.
But let's look at the financial fallout of this. The market reaction, wow. Investors looked at this announcement yesterday, and they just panicked. We saw a massive sell-off in traditional cybersecurity stocks immediately.
It was a bloodbath for that specific sector.
Yeah.
I mean, we saw CrowdStrike down nearly 8%, Cloudflare down over 8%, Zscaler down about 5.5%. In one single day.
That's huge.
We're talking about over $15 billion in market cap, wiped out from just a few companies, all based on one tweet and a blog post from Anthropic.
Why the panic, though? I mean, CrowdStrike and Cloudflare are massive, entrenched companies. They are the enterprise standard. Why does an AI code scanner threaten their business model so deeply?
Because it challenges their fundamental value proposition. Think about it. Why do you buy CrowdStrike? You buy it to put a fortress around your endpoints because you assume there are vulnerabilities in your software that attackers are going to exploit. You are paying for a guard because the castle walls have holes in them.
Right, it's an insurance policy. It's protection.
But if an AI agent can natively repair the code, literally find the bug, and rewrite the code to fix it before it's ever even deployed, then the software becomes inherently secure. If the castle walls are solid titanium with zero holes, do you really need to pay millions of dollars a year for the guards walking the perimeter?
So if the building is built perfectly fireproof by the AI from day one, you don't need to pay as much for the fire department.
Or at least the fire department doesn't need to be nearly as expensive or expansive. It's about value destruction in the legacy tech stack. Investors are fearing that AI-native code repair will just commoditize the prevention side of cybersecurity. I mean, why pay for a massive firewall to catch an exploit if the exploit doesn't even work anymore?
That is a massive shift in thinking. And this feeds directly into the broader thesis that has been circulating all week, the whole death of SaaS narrative.
Oh, I saw that chart. It is everywhere right now. The software death cross. It predicts this crossover point in 2027 where the cost of software effectively goes to zero.
It's a viral narrative for sure, but the data behind it is actually pretty compelling. Since January 2026, we have seen $1 trillion wiped from software stocks. That is a staggering amount of wealth destruction.
But look at the valuation collapse to go with it. At the peak of the COVID bubble, let's call it the peak of the free money era, SaaS companies were trading at 18.5 times their forward revenue.
Which is just astronomical.
It was a total mania. Today, in February 2026, they are trading at 4.8 times. That is a brutal repricing of reality. Meanwhile, the AI market surged from $50 billion to $539 billion in that exact same time frame. The money's rotating violently out of renting software and into building intelligence.
The core argument here is really about the business model, right? The per-seat pricing model.
Yes, and this is crucial for every business owner listening to understand. For the last 15 years, the entire software industry was built on one single metric: seats. How many humans can we get to log in? You charge $50 per user per month. Salesforce, Slack, Zoom, it is all seat-based. If you grow your company and hire more people, you automatically pay them more money.
But now we have agents.
Right. The argument is, why pay $50 a month for a human seat when an AI agent can do the exact same task for 0.0003 cents per task?
That math is brutal. $50 versus a fraction of a penny.
And it's not just the cost of the software, it's the cost of the labor itself. There is a report we looked at suggesting that 10 agents can effectively replace 100 humans in certain back-office workflows. So if a company fires 90 humans because 10 humans augmented with AI agents can do all the work, That company now needs 90 fewer SaaS seats.
So the total addressable market for these traditional software companies just permanently shrinks.
It collapses. If your revenue model is entirely tied to human headcount and AI fundamentally reduces human headcount, your revenue goes to zero. These companies are the walking dead. They just haven't realized it yet because they're still currently locked into multi-year enterprise contracts.
It's really interesting to trace the timeline on how fast this happened. I mean, we had ChatGPT kind of open the door to this back in 2022. Then in 2025, we got Claude Opus 4, which is what made agentic AI actually real, meaning it could actually execute tasks, not just talk to you.
And now, here in 2026, we have OpenClaw and these multi-agent coordination systems. This makes it fully deployable. It is no longer just a cool science project. You can actually have a swarm of agents doing your customer support, your data entry, your basic coding workflows.
So for the listeners who are either investors or founders in the tech space, the message is pretty stark.
It is very stark. If you are building a company entirely on seat-based pricing right now and you don't have a proprietary data advantage, meaning if you're just a wrapper around a workflow or an API, you are in deep trouble. You are fighting a massive deflationary force that is driving the cost of digital labor to absolute zero.
Deflationary force is a very polite way of saying your business model is about to evaporate. But let's pivot for a second. If SaaS is dying because the AI is getting so incredibly good, we really have to ask, how smart is this AI, really? Because there is a huge debate right now about AGI, artificial general intelligence, and when we actually cross that threshold.
There is. And Demis Hassabis, the head of DeepMind, has recently weighed in with something that I think is really profound. He has proposed a completely new test for AGI.
The Einstein test.
The Einstein test. He said, forget the Turing test. The Turing test is basically just a parlor trick, and you fool a human in a chat box. And forget these coding competitions or bar exams, which are largely just about retrieving syntax and memorized facts. Hassabis says, train an AI on all human knowledge up to the year 1911.
Okay, 1911. Why that specific year?
Because that is just before Albert Einstein published general relativity. So the AI knows all the physics, all the math, all the science that humanity knew in 1911. It knows about the anomalies in Mercury's orbit. It knows all of Newtonian physics. And then you ask the AI to independently discover general relativity.
Which Einstein did in 1915.
Correct. The point of the test is, can the AI derive a massive paradigm-shifting theory from first principles? Can it make a true creative leap that isn't just remixing what it has already seen in its training data? Can it actually invent net new knowledge?
That is a much, much higher bar than just passing the bar exam or writing a sonnet in the style of Shakespeare.
It is the ultimate bar. Because right now we are in this weird phase that researchers are calling jagged intelligence.
I love that term, jagged intelligence. What exactly does that mean in practice?
Imagine looking at a mountain range. The AI has these massive, towering peaks of absolute genius. Hassabis points out that current models can win a gold medal in the International Math Olympiad. That is elite, 1 in a million, genius-level math. But then, if you phrase a simple elementary math problem in a slightly weird way, or ask it to navigate a really simple physical logic puzzle involving stacking blocks, the model completely falls over. That's the deep valley.
So it lacks a unified world model. It doesn't actually understand the math the way we do. It just simulates the patterns of the math.
Exactly. A true AGI, much like a human mind, has consistency across domains. If you are smart enough to solve general relativity, you are also smart enough to figure out how to open a door or make a cup of coffee. You don't spike to genius in one hyper-specific area and then collapse into total incompetence in another.
And Hassabis says we are just a few years, not decades, away from a system actually passing this Einstein test.
And that is the terrifying and exciting part of all this. If an AI can be Einstein once, if it can execute that profound level of creativity and derivation, it can be Einstein 1,000 times simultaneously.
Right. You could have an Einstein for biology, an Einstein for material science, an Einstein for global economics, all of them running 24/7 on server farms.
That represents a complete phase change in human productivity. That whole SaaS is dying narrative we just spent time discussing. That is just a minor tremor before the massive earthquake. If we hit that level of general intelligence, the entire fundamental concept of labor changes overnight.
It really feels like we are standing on the edge of a cliff, just looking down at a completely different landscape. But, while we are looking forward at the future of AI, the ghosts of our past economic decisions are coming back to haunt us in the global economy. Let's talk about Japan.
Yes. The macro situation. This is the stuff that isn't as sexy as AI robots replacing coders, but it's exactly what actually breaks the global financial system.
We have this massive headline. an $86 billion hole. Japan's four largest life insurers have just reported record unrealized losses on their domestic bond holdings.
Just to put that in perspective for you, those losses jumped 125% year over year in the fourth quarter of 2025 alone.
A 125% jump. That is basically a vertical line on a chart.
It is. We are looking at 13.2 trillion yen in total paper losses. Nippon Life, which is the biggest player over there, a absolutely huge global institution, they have about $36 billion in unrealized losses just by themselves.
Okay, let's unpack unrealized losses for a second, just so everyone is on the same page. This is kind of like when you buy a house for $1 million, the local market crashes, and now Zillow says it's worth $800,000. You haven't actually lost the $200,000 until you were forced to sell the house, right?
Technically, yes. But here is the massive problem. Insurers aren't just regular homeowners sitting on a couch waiting for the market to recover. They have immediate liabilities. They have to pay out life insurance claims. They have to pay out monthly annuities. They constantly need liquidity. If they are forced to sell these bonds to raise cash to pay those claims, those paper losses become real, permanent cash losses immediately.
And that completely destroys their capital buffers.
It renders them functionally insolvent. If you have to sell an asset for 60 cents on the dollar just to pay a daily claim, you go broke very, very fast.
How did they even get into this massive mess to begin with?
It is the classic higher for longer trap. For decades, literally decades, Japan had zero or even negative interest rates.
The ZRP era, zero interest rate policy.
Right. So if you are a Japanese insurer, you need safe, yield-bearing assets. You buy Japanese government bonds or GGBs. They paid almost nothing in yield, but they were considered entirely risk-free. The insurers just loaded up their balance sheets with these long-term bonds.
And then the world changed.
The Bank of Japan finally had to normalize their policy. They ended the negative rates. They stopped buying so many bonds to prop up the market. And when they did that, yields naturally rose. And this is just bond math 101. When yields go up, bond prices go down.
So the principal value of all those safe bonds sitting in their vault just collapsed.
Exactly. Since 2023, the price of these specific bonds has been in absolute free fall. And now, in early 2026, we are seeing the cumulative damage of that policy shift.
The reaction from the Japanese authorities is, well, it's interesting. I'm reading here that a Japanese accounting group is actually proposing to just relax the rules on how they record these losses.
Yes, the classic change the rules so we don't look broke strategy. It is a massive kick-the-can maneuver. They want to avoid triggering technical insolvency. They really don't want to force these insurers to sell, because if a giant like Nippon Life starts dumping billions of dollars of government bonds onto the open market, what happens to the market?
Well, yields would spike even higher, bond prices would crash even further, and everyone else holding those bonds gets absolutely crushed in the stampede.
It becomes a total death spiral. And this isn't just a local Japan problem. That is the critical point for our listeners to understand. Japanese institutions are massive buyers of global debt. They hold huge amounts of U.S. treasuries, European bonds, Australian debt.
So if they're distressed at home with their domestic portfolio,
They stop buying abroad.
Yeah.
Worse, they start selling off their foreign assets, dumping U.S. treasuries just to cover the massive hole back home. That sucks liquidity out of the entire global market. This connects directly to the carry trade unwinding we've seen flashes of. If Japan pulls back its capital, who is going to step up and buy the U.S. debt? Who buys the European debt?
it really feels like the bill for the last 20 years of easy 0% money is finally coming due all at once.
That is exactly what it is. Institutions that were entirely built for a lower for longer environment are structurally breaking in a higher for longer reality. Japan is just the canary in the coal mine right now, but it is a very, very big canary.
So we have the digital world transforming violently with AI agents. We have the financial world cracking under the intense pressure of normalized interest rates. Now let's look at the physical world, the real economy, specifically the luxury market.
This is such a fascinating indicator of consumer psychology and overall liquidity in the system.
We are seeing a major undeniable correction in what they call passion assets, watches and whiskey.
The Rolex recession, as some analysts are calling it. Look, during the pandemic, everyone was flush with free money. Crypto was booming to the moon. Tech stocks were up. People poured insane amounts of money into luxury watches and rare whiskey, not to actually enjoy them or drink them, but purely to flip them for a profit.
It was pure speculation, just treating a bottle of liquor like a meme stock.
Pure speculation. And now, in February 2026, the data shows a really significant cooling. The Knight Frank Luxury Investment Index is noticeably down. The Live X Fine Wine 100 index is down 3.4%. Prices for rare whiskeys, things like Macallan, Springbank, Yamazaki, they have absolutely plummeted from their peaks.
There is a great quote in our sources here from a fine wine consultant. He said, "Flippers are leaving, drinkers are returning."
And that is actually the healthy part of the market correction. When the tourists, the people who are just there to make a quick buck on zero interest rates, when they leave the market, asset prices finally return to reality.
It's the exact same story with watches. The secondary market for Rolex, Patek Philippe, and Audemars Piguet is correcting, but it's still falling. Supply is super high right now because cash-strapped owners are being forced to sell their collections.
And again, notice the term cash-strapped. Why are they suddenly cash-strapped? Because interest rates are high, because the easy money tap was turned off. They need immediate liquidity, so they sell the Rolex they bought in 2021. It all connects right back to the macro picture we just talked about.
But not everything physical is crashing. There is this weird niche trend popping up in the sources regarding lifestyle and business. Floral design.
Yes. Flowers are the new yoga.
I genuinely did not see that one coming in our research.
It is fascinating, though. It is moving rapidly from just being a casual weekend hobby to a booming subscription business model and a major corporate expense. But you really have to look at the psychology driving it.
What is driving it? Why flowers?
In a world that is becoming so overwhelmingly digital, where AI writes your code, AI handles your emails, where literally everything of value is on a glowing screen, people are deeply craving something tangible, something exquisitely ephemeral.
Right, because flowers die. You can't put a physical flower on the blockchain. You can't saucify a tulip.
Exactly. It's distinctively physical. And the trend isn't even for those stiff, structured, artificial-looking arrangements anymore. People specifically want wildflowery, natural looks. They want imperfection.
That makes total sense. If the AI can generate a pixel-perfect, flawless image of a flower bouquet in a millisecond, the real, slightly imperfect flower sitting on your physical desk actually becomes a status symbol of reality.
It is a flight to reality. As digital value becomes completely abundant and cheap, like we discussed with the 0.003 SaaS agents, distinct physical value, things that fundamentally cannot be copied or generated will hold their ground.
That is a really profound thought. We are basically witnessing a total bifurcation of value.
We really are. The lines are being drawn right now.
So let's try to synthesize this whole deep dive because we've covered a lot of ground today. It feels like the world is splitting in three distinct directions simultaneously.
It is. First, you have the digital side. We are seeing a violent, unstoppable rotation away from legacy software, the whole per-seat SaaS model, and toward autonomous AI agents. The software companies that don't adapt to selling agents instead of seats are going to zero.
Second, the financial side. We are seeing the painful, really messy unwinding of the zero interest rate era. The Japan bond crisis is the absolute smoking gun there. You simply cannot print free money for 20 years without facing structural consequences when the rates normalize.
And third, the physical side. We are seeing a return to sanity and fundamental value in the real world. The speculative bubbles in luxury goods are popping, and people are actively looking for tangible, authentic experiences, even if it's just spending time arranging imperfect flowers.
It is a lot to take in for one weekend, but for our long-term investors listening, we promise some concrete, actionable takeaways. We've distilled the 5 to 10 key developments from all of these sources. Expert, walk us through what matters most for the portfolio going forward.
All right, here is what you need to be watching closely. 1, the software death cross is approaching, likely around 2027. Be extremely wary of SaaS companies that rely on per-seat pricing. The market is re-rating them significantly lower right now because AI agents are replacing the human users. If their core revenue is tied to human headcount, they are in extreme danger.
Got it.
2, cybersecurity disruption is officially here. Companies like Anthropic are aggressively entering the security space with code-level reasoning analysis. This could deeply commoditize external security platforms. If you hold legacy stocks like CrowdStrike or Cloudflare, you need to watch very closely how they respond to AI-native code repair.
That $15 billion drop was just the warning shot.
Exactly. 3, the rise of agentic economics. The cost of labor for digital tasks is dropping to near absolute zero again, 0.003 cents per task. Look for the non-tech companies that are aggressively leveraging these agents to reduce their operating expenses, not just the tech companies selling the tools. The real winners are the traditional businesses who figure out how to deploy cheap agents to boost their own margins.
That's a great distinction.
4, Japan's bond crisis is a massive systemic risk. Those $86 billion in losses at Japanese insurers are very real. Watch for potential liquidity crunches. If Japanese institutions are forced to sell global assets to cover domestic holes, we could see a sudden liquidity shock in both U.S. and European debt markets.
Contagion is the word to watch there.
5. Duration risk is incredibly real. The higher for longer rate environment is still actively breaking financial institutions that haven't adapted. We saw it first with the U.S. regional banks a while back, and now we are seeing it with Japan's major insurers. Just avoid over-leveraged sectors that fundamentally depend on low interest rates to survive.
Keep your duration short.
6. The AI verification gap. We are currently in that jagged intelligence phase. The AI is brilliant, but it is brittle. There is a huge untapped investment opportunity in the secondary tools that help verify and audit AI output. Bridging that gap between it looks right and it is mathematically right is where a lot of venture money will be made before true AGI arrives.
The picks and shovels of the AI. Boom.
Exactly. 7. The AGI benchmark is now the Einstein test. Stop looking at basic coding benchmarks or standardized tests. Watch closely for AI systems that demonstrate genuine discovery. The exact moment an AI creates net new knowledge from first principles, that is the ultimate valuation inflection point for the entire sector.
He changes everything.
8. The luxury market reset. The pandemic speculative bubble in collectibles is dead. The quick flip trade is completely over. It is now strictly a buyer's market for long-term holders who actually enjoy the physical asset, but do not expect 20% annual returns on a steel watch anymore.
Buy it because you like it, not because it's a stock.
Right. And finally, number 9. The tangible versus digital balance. As digital value becomes infinitely abundant and basically free due to AI agents, distinct physical value, things like rare goods, in-person live experiences, access to nature, these may actually hold their value much better as a long-term hedge against all that digital abundance.
That is a incredibly powerful list. It really frames the risks, but also the real opportunities hidden in this chaos.
It is a landscape of massive extremes.
Oh.
Extreme risk in the old models, but extreme generational opportunity in the new ones.
I want to leave the listeners with one final thought to kind of tie this all together. We talked about the Einstein test, and we talked about AI agents replacing human software seats.
Go for it.
If an AI can replace the software you use, and the software you used previously replace the people you hired, and the AI can eventually pass the Einstein test and replace the raw creativity you thought was entirely unique to humans, what is the only asset left in the world that actually has enduring value?
That really is the ultimate question for this decade. Is it the physical land? Is it the raw energy required to run the data centers? Or is it simply the authentic human connection that fundamentally cannot be simulated?
It's definitely something to mull over this weekend while you arrange some imperfect wildflowers on your desk.
Or, while you desperately check your bond portfolio.
Or that. Definitely do that. Everyone, check your portfolios this weekend for seat-based exposure and hidden duration risk. It is going to be a very bumpy ride from here on out. Thank you for joining us, and we will see you in the next Step Dive.